Hey guys, this is Jorge from the Big Band Podcast. Today I'm joined by Martin. He is a two-time entrepreneur, venture capital investor, and an investment banker. He just recently shared with me a very interesting article on how to boost a startup's attractiveness to venture capital investors using the business model canvas. It's a 7,000 word in-depth article that I found very interesting, and I invited him to discuss it with me.
Good stuff.
Thank you, Martin, for joining me.
Thanks, Jorge, for having me.
So, can you just give me a short introduction about yourself, what you've been up to, and what is the reason that you ended up writing a huge article?
Right. So basically, for the last 9 to 10 years, I've been starting several companies for myself and with my co-founder. And so one is the Finance Club, which is basically a large online community of 850,000 people, which are mainly finance professionals. And the other one is Cleverism, which is a job matching platform. And both of them are in English-speaking countries, so mainly US, UK, and Canada. And over the last 3 years, I have helped several startups raise money from venture capitalists, but basically only due to my personal relations to friends of them or other entrepreneurs. And for the last 8 weeks, I tried to make it a little bit more professional with Road to Funding. And therefore, I reached out to you with my article. And my main so the main thing that I was seeing with other first-time entrepreneurs mainly is that they just have a business idea and then they think, wow, that's a great idea, let's reach out to an investor. But this is not how the world works. Yeah? So, and because then the people are wasting like 6 to 12 months trying to reach out to investors and always getting a no. And most of them only realize too late, and after they've wasted their time, that they won't get funded. And then they've lost time, and the window of opportunity maybe is lost. Therefore, I wrote this particular article and shared it with you.
Yeah, I'm an entrepreneur myself. I've been a part of I think 12 startups, both with funding and bootstrapped. I can tell you that raising funds is not. I mean, it shouldn't be easy.
Right.
I've been lucky that it's happened, relatively quickly. But I have been a part of other ones that took some more time, and I've also helped entrepreneurs raise capital myself. But I've never, kind of went through, using a guide of some sort. And like you, I get these questions a lot. So when you shared this with me, I was like, man, we gotta talk about this, because I found it interesting. The name of your article starts with it's basically investment readiness. So that by in itself, because what makes a startup investment ready?
So let me answer this question briefly. So you need to put yourself into the shoes of an investor, right? And basically, they are not looking for some fuzzy idea which might work or which might not, because how would they be judging it, right? So they want to see some kind of validation. And whether it's by you talking to customers and validating, oh, there's a really big pain point, which basically results in many customers having this, which is basically a big market opportunity. And you trying to validate that you found some type of a solution to solving this kind of problem. And even if you only make this with a click dummy or some other kind of mock-ups or so, but you need to validate this, yeah? And I've seen so many entrepreneurs who just go with an idea, did not check even the basic stuff, yeah, not even talk to customers. And this is so stupid. Why do you expect somebody to give you, I don't know, $500,000, $1 million US dollars whatsoever, if you were so lazy and not even talk to your customers? And I mean, venture capital, for example, is not there to for you to validate your assumptions. It's basically there for you to scale up and boost you on your specific path. Therefore, and the cool stuff with technology that is available nowadays, it's so cheap to validate those assumptions yourself. And my assumption is every person that has studied or so can spend $10,000 to $20,000 on really validating the critical assumptions, on that there's really a pain point that is to be solved, and they find some specific angle on how to solve that. Yeah, and once they've validated that, found maybe the first paying customers, then they can go out and raise some money. Yeah. Okay. And this is basically what is coined with the terminology investment readiness. So because there are different levels, and from, let's say, it cold, which means you get basically always a no from investors, to hot, you get maybe like 20-30% conversion rate when talking to an investor. Yeah, and cold means basically you just have a rough, fuzzy idea and say, oh, I've got an idea for a nice mobile app. Okay, did you talk to customers? No. Did you build something? No. Did you have the first customers? No. But I will try to convince an investor to give me $500,000. Doesn't work. Or to the other extreme, you already talked to customers, you shipped your first iteration, and you hired some kind of techies and it shipped this, got the first 100 paying customers, and maybe, I don't know, $10,000 in monthly revenue. And you even know your customer acquisition cost, and you have some kind of estimate on what the customer lifetime value is. And only then you go out to investors and say, guys, I've validated there is a market. I found people who are buying my stuff. I have a good estimate of the unit economics. And now I'm looking for 1 million to really scale my business from $10,000 in monthly revenue to $200,000 in revenue. And therefore, I'm looking for 1 million. This is what I would call a hot investment readiness, okay? And there's, of course, some kind of universe in between, depending on how much money and resources and drive you have in order to validate your critical assumptions with the resources that you have.
Okay. Now, I've you were talking about doing the bootstrapping yourself, bootstrapping both of your ventures. Now, is there a reason why you decided not to take investment or raise funds?
Yeah. So the thing is, when I was a little bit younger, so like 2008 or so, and I was working on some business ideas back then. But in Germany, the VC industry was not very much existent. So there were like 3-4 investors, but they, from my point of view, they didn't really have a clue on what it was because it was very new back then. And I was a student back then as well, so I did not have a track record from their point of view. Programmers were not willing to code in exchange for equity, and I did not have the cash to pay them, even though we had some kind of letters of intent signed from big companies who wanted to buy our product once we can ship it. But we didn't. But we tried to raise money like for 12 months or so, yeah, from investors, $1 million back then. But we are not able. So, which means we either can try, but still we were not investment ready, basically, right? Because we did not have a product yet, etc. Although we talked to customers. So I would say this is maybe level 2 in terms of investment readiness. But from my point of view, we would need to get much further in order to be attractive for investors. So, which means we changed our strategy and thought, what can we really do with the resources that we have? What type of traction can we generate? And then we came up with this idea of the finance club. So basically, this I always try to tell people, try to get as far as possible with the resources that you have, and show some kind of traction. Yeah, and even if it's a very small niche market that you are trying to serve, it's much better to find, I don't know, 5-10 customers and then take it from there, and maybe afterwards change your business model. But at least you can show some type of traction to investors.
Okay, so that was where I was going with the question, because now that was like 10 years ago, almost 10 years ago. Nowadays, like money is, there isn't a day that doesn't go by where you don't see news that, so and so raised so much money and all this stuff. You make the idea there's a bunch of money waiting, but at the same time, just because the money's out there doesn't mean we have to go get it.
Right.
Especially
and the reason is very simple, because you see this currently with the ICOs, right? This newer type of funding, yeah, where startups with no validation at all are raising stupid amounts of money, yeah, in terms of virtual currency. And the problem with that in the good old traditional venture capital is like that. Due to the waterfall logic, it's if you are getting in an investor and due to the liquidation preference, you are getting your cash back the latest. So which means, if just making an example so that first-time founders understand that, if you think your company is worth 5 million right now and you are raising, I don't know, 2 million, which means you have a post-money valuation of 7 million and 2/7, which is basically the equity share that you're giving to the VCs. If you are not able to take this 2 million cash and convert it into maybe 10, 20, 30 million of enterprise value, but maybe only towards 2 million or 3 million, then you are not getting for 3, 4, 5 years hard work, you're getting almost nothing, right? And this is a big problem with if you're raising too much too early. Yeah. Therefore, it's much better to maybe raise a round of 1 million, 2 million, and get to the next milestone, and then raise a bigger round, basically.
Yeah, I agree with that, and I think that's one of the parts that a lot of entrepreneurs do or have no idea about. I've been lucky to progress at different stages, and I see it immediately with first timers. Yeah, I mean, it's they see the money and they're like, I want to take it. They believe it's going to save their life.
but the thing is, raising money. So from let's take a step back. So basically, there are two big tasks that every entrepreneur should be very, very good at. Which one is really focus on validating customer problems and finding a problem solution fit together with your team. And the second one is raising money. The cool stuff is, the first one, you can do so many experiments because there are potentially thousands, and for B2C business models, even millions of potential customers. So you can do trial and error. This works. You can do A/B test. Awesome. Yeah. With raising money, that's not the way it is, because there might be only like 10 to 20 investors that are potentially interested to invest in your stage, your industry at this current moment in their fund life cycle, etc. So you need to do everything that you can do in order to increase the conversion rate from approaching this type of investor to closing this investment deal. Yeah, because if you don't, you won't get funded. Yeah, that's not a big problem with finding a customer. So this is basically what I see with lots of entrepreneurs. They are just spamming around, trying to approach so many investors without thinking about what is the right investor.
Yeah. What is well, taking that further is why are the common reasons why they fail to raise money?
Yeah. So most of the time, the biggest reasons that I see is first that they are. That's not the right time to raise money. Either most of the time it's too early because they don't have any traction, so there's no investment readiness at all. Or the other one, it's too late. So there are several startups who are coming to me, and then I ask, okay, so how much cash do you have on the bank? What is your burn rate? And then I find out, oh guys, we only have cash for 2 more months, and I'm like, did you realize that raising money takes some time? Most of the time, like 6 to 9 months. Did you build some kind of relationships with potential investors already? No, I did not. Okay. Do you have your financial model and pitch deck ready? No, but I will start working on it. And I'm like, okay, how do you want to raise money in this 2 months? It's it's like winning a lottery. Yeah. So this is, one is too early, not investment ready, and the other one is too late. Other reasons are that they are failing is that they don't understand the process. So they are very type of naive, and they think, oh, I can spend like maybe 2, 3, 4 hours every week for the next 3, 4, 5 months, and not very structured. And maybe I will write to some investor on LinkedIn or Interest tomorrow, and then of course my business model is so awesome, and it's easy to raise money. This is not how it works. So basically, what every entrepreneur should be understanding is that the CEO or the CFO, depending on the size of the company, this is a full-time job, yeah, basically for like 3 to 6 months, which means you have to, for example, reach out for 2 or 3 weeks, every hour of the day to potential investors, meet them, have a beer with them, talk with them, then preparing the necessary documents. Yeah, and and there are also different problems that can arise. For example, lots of first-time entrepreneurs, they don't know how to build a transparent, easy to understand financial model. Yeah, that's what I'm helping them with, for example. Or they are so deep in this, oh, cybersecurity, this is how my database model works and so on. But explaining this to investors who've potentially never seen this type of business model before in like 30 seconds, they are not able to do that. And then the investors are not hooked, and they will just say, I don't understand this business model, I'm out of here. Yeah. So, and then there are some other components, for example, due to the fact that they are only talking like to 2, 3, 4 investors, they are not able to have this kind of competitive situation where they are able to have maybe at the same point in time having 2 or 3 term sheets. Yeah. So it's basically, if you are only talking to like 2, 3, 4 investors, or let's say 10 investors, and 2 or 3 of them are only relevant to you, but you are talking to one of them today and the other one in 1 month, guess what? You at one point in time, you only get 1 term sheet, and then you have like 2 weeks where you can accept it or decline it. That's it. So you have no competitive situation. Yeah, and this is also entrepreneurs who don't know that.
Okay, that you brought up a good point about reaching out to investors. That's not explicit in your article, but I'd like to go over that with you. Like, how do you tell entrepreneurs to do the reaching out? What do they need to have the moment when they reach out?
So what I always tell the startups that I advise is, first, you need to select what type of investors are right for you, depending, for example, on the investment stage, on whether you want to have an active or more of a passive investor, what stage, what fund, what life cycle they are currently. So did they just close a fund, or are they more in the holding period, which basically means they don't invest? Yeah. Are they more of a short-term investor or long-term oriented? So there are different type of criteria where you should be looking for. Once you've found 5 to 20 investors that you think are a good fit for your company right now, then what I always say is the simplest way, and there are other ways as well, yeah, but is to really go on their websites or Crunchbase, look at what type of portfolio did they invest in, and see whether your company would be a good asset in this type of portfolio. So not that, for example, they already have 2 similar companies invested in, which basically means they won't invest in yours. And and you will also see, for example, on Crunchbase, on what are the typical investment or ticket sizes. Yeah. And then the next step, once you found all the portfolio companies, then just go to LinkedIn and check out, or Crunchbase, and check out who are the founders of those companies. Write them down into an Excel file, and then trying to connect with them on LinkedIn or via email. You can easily find out their emails on Google and so on. There are also some methods to do that. And then reach out to them, and then simply write to them and say, hey guy, I saw you've raised X amount of money from VCA. I'd love to chat with you about, for example, a specific industry, if you are in the same industry, yeah, and see what I've learned, what you've learned, well, maybe this is very helpful for you. But really think about what is the value add to this type of entrepreneur, not to you, right? So because nobody will talk to somebody who's only egoistic, yeah? And once you have that, doing some kind of Skype sessions with them, or even better, meet locally with them face to face, so that they know you, learn about your business model, trust you, and then really ask for an introduction. Because if you look at what type of deals get funded, less than 0.2% of the deals are getting funded based on ice cold email outreach directly to a VC investor. It's just wasted time, because you will need this type of what I call trust conversion, yeah, where you are talking to somebody who they trust already, build trust with this person, so that he can make an introduction and convert the trust that he already has with this VC to you, and then the VC will basically listen to your pitch. Yeah. And then the next step is basically to show that you have enough traction, basically investment readiness, and then convince the investor that it's a good investment case where he can expect to potentially get a 10x, 20x investment return.
Very good. Okay, now let's move forward with that. You just you went through to the next question. Is so you talk about the investment readiness. Article is model canvas. What? So let's say I'm an entrepreneur. I'm going to meet with an investor. Do I literally bring the business model canvas laid out?
No, this is not necessary. So basically, how this would be working is the business model canvas, from my point of view, is just a tool to ask the right questions in a specific order. That's everything it is. Yeah. So basically, that you don't miss. Oh, I've got customers. I need to find a pain point at, or I need to think about what is specifically the value proposition that I'm offering them, and how am I delivering that. So this is just from my point of view. This is not where you take this kind of framework to an investor and discuss this with them. Yeah. How you typically would be doing that is that you put specific information from this pitch deck and from your validation into your pitch deck, where you basically will say, hey guys, we've identified a problem from customers, and this is how we validated it. For example, we asked 100 companies of type X, yeah, what is their biggest issue with value chain Y, yeah, and this is how their response. Okay, then we've asked them what is their willingness to pay, to really assess whether they are whether this is a big problem that we might be solving. Okay, problem set in the pitch deck. Then you can talk about the solution. So what did you do to validate that your solution really delivers value? And then you can, depending on the traction that you have, you can either say we did not do nothing, which is really bad, or you say, okay, we showed them some kind of screenshots or mock-ups, etc., on what the potential solution might be. And we asked 100 of those specific customers, who have this problem, and 30% said, wow, that's awesome. That would be really solving our pain point. And by the way, we would be happy to give you $200 every month. Or if you take this a step even further in terms of the investment readiness, you have built something where you can already say, okay, we have some customers signed up. Yeah. And if you would be taking this even further, then you can show on a traction slide in your pitch deck that you already know your unit economics, for example, where you say, okay, we already acquired like 200, 1,000 business customers, for example, and we know already how much money we are making with every customer, what marketing or customer acquisition channels are performing well, and which we can basically scale. Yeah. So this is where all this type of information from the business model canvas comes into the pitch deck.
Very good. Yeah, I mean, I had to ask the question because we have to be explicit as possible, especially for the first timers. Now, you mentioned in your article that there are certain factors that determine or help the investor determine whether or not you're investment ready. Can you just go through them a little bit?
What are you referring to specifically?
Yeah, there's a part in the article right at the end where you talk about those I think it's 3 factors that from the point of view of an investor determines if they're ready to go, and give you some money.
So I can't remember right now, but my answer to this. So the typical investor looks at the team because especially in the early stage companies, there are so many guesses, or call them scientifically hypotheses, yeah, but it's basically educated guesses, and the investor only walks in once a month or so, and when you're having a board meeting. So all in between, it's you making 1 million micro decisions, and basically this is what is called execution, and this is responsible whether you are successful or not. It's not the big decisions which you are doing once a year or so. It's the sum of the micro decisions, and therefore investors look at the team. Can they trust them that they are making the right capital allocation decisions? Yeah, when they are not looking. The next thing what investors are looking at is what is already there. So what type of traction is already there, which can show me that the team might be good, that the team might be on something. And the more traction you have, the easier it is to raise money, because if you don't have traction, everything is team, yeah, and then you need to convince that you are a rock star team, that you're complementary, maybe, and this is even easier if you have sold your last company for 50 million or so. But if you're a first-time entrepreneur, this is the first company basically, then you don't have that, yeah. So which means you need to have some type of traction, and the thing that most VCs want to know is, can I scale this business? So if I'm writing you a check of $1 million or so, are you able to turn this immediately, not in 12 months or in 24 months, but you can, do you have some initiatives that you want to invest this money on immediately once I give you? Do you know what type of people do you want to hire? Yeah. Do you know where do you get them? Maybe you have already some type of a short list of candidates, or if you want to scale the customer acquisition, do you know where you want to spend this money? Do you want to do performance marketing on Google AdWords, Facebook, etc., or do you want to spend it on TV or build a direct sales force, whatever? Yeah, but do you really know where to spend this money, and not say, okay, I've raised $1 million, but actually I don't know where to spend this money, which is stupid. Yeah, and then the investors want to really understand that there's a huge market opportunity, because the logic of investors works like this. If your pre-money valuation is like 5 million and they are investing 2 million, they have basically, like, let's assume like 25% of the company, yeah, approximately. And in order for them to make a 10x return, basically, your company would need to be sold for 100 million. Just with their investment of 2 million, and if this company needs to be sold by 100 million, are you sure that the market is at least $1 billion? Because this would mean that you would need 10% market share, right? This would mean if you are in such a small market, then investors can't get a return. So I've seen several companies and startups which I had to decline and really get back to the reality and say, hey, your market is much too small, or too niche, or not scalable, yeah, in terms of it would take too much time in order to get it from where it is right now to generating like 10x in revenues or profits whatsoever, that it's not attractive for VCs. Yeah? Because you need to understand, they typically want to exit the company after 5 to 7 years. So during that time, they expect to realize a 10x return. Of course, they don't get it for every portfolio company, right? But they at least want to have the expectation. that every portfolio company could get there.
Yeah. No. Yeah. Go ahead. Go ahead.
So these are basically the things that VCs are looking for in the startup.
Okay. Now, have you noticed? Because let's say we live in a tech-dominated world now. Mm-hmm. Have you noticed the change from traditional investors, let's say 10-15 years ago, to now, how their mindset has changed to tolerate, educated guesses that technology, brings?
Yeah. So I think there are different factors playing into that. So my short answer would be it's easier to raise money right now because there's lots of capital out there, but the problem is only for validated business models. Yeah. So if there's no traction, so it's hard. If you have some traction, it's easier, especially if you are following the right process logic. And why is capital easier? Because lots of the limited partners who are basically investing into venture capital funds, they are trying to find higher yields. And if you're looking at insurance companies, which is or pension funds, which are one type of limited partners, they don't get this kind of high yields investing in state bonds, government bonds anymore. Therefore, they are allocating more money into private equity funds, venture capital funds, hedge funds, etc., and with the expectation to getting higher returns. So this is putting lots of capital into the venture capital world. The other major change from my personal observation is that the mindset of venture capital investors has changed a little bit and going away from I want to minimize my downside risks to I want to maximize my upside potential. And therefore you have this hypothesis that it's even better to invest a little bit more into a specific startup, because by giving them more money, and maybe even if I'm giving them if I'm paying too much right now, I'm actually increasing the probability that I will get a decent or maybe a great exit later on. Yeah, so this also drives especially the Series A and Series B round valuations.
Okay. Now, how do you? I mean, this is a finance question also. How does an entrepreneur determine how much money to raise?
Yeah. So typically, of course, this depends on so many factors, but assuming you are not expecting a big financial meltdown, which means you should be raising money just to survive for the next 3 to 4 years, assuming this not to be the case, I would be always looking for what specific initiatives do I have that could add value to my business and really grow my business. If I only identify concrete initiatives for 500,000, then don't raise 2 million. If you identify, if you find some really some initiatives that could provide a positive return on investment, yeah, where so that you would even spend your own money on that, and for 2 or 3 million, then try to raise 2 or 3 million. But of course, there are other factors playing into that, which is basically traction. So the more traction that you have, the more money that you can raise. And I would always look only for having enough money for the next 18 to maximum 24 months. Yeah. So if you are raising money for 3, 4, 5 years, it's too much. And if you are raising only money for the next 6 months, it's too few. Because again, as I said in the beginning, it takes you 6 to 9 months raising money. And typically how it should be working is 6 to 9 months raising money, and then 18 months focusing only on operations and execution, growing the business.
Okay. Now there's how do you because usually it's very rare that you find a team of one. There's usually either 2 or 3. Does the fundraising has to be done by what type of person on the team?
Yeah, so it depends on what the team constellation is. So if you don't have a CFO, then the CEO should be doing that. Yeah. So which means the CEO should be allocating 80-90% of his time towards fundraising, and all the operations growing the business he should be delegating to his other co-founders, basically, for the time when he's fundraising. And he should be only going out there working on the documents, etc., and meeting investors. If you are a little bit later stage, okay, let's call it a little bit later, yeah? So it's not later stage. So if you are, for example, already past Series A and you have hired already a CFO, then the CFO is responsible for that, and he should be allocating like 50 to 70% of his time towards fundraising. And the CEO should be maybe then allocating like 10 to 20% of his time.
Okay, very good. Well, I don't know. Do you have anything more to add? I mean, I think I'm pretty covered. I feel as though we covered a lot of it. I don't know if we're missing something you want to add to anything else.
I think the key message for entrepreneurs really is get out of this planning bullshitting modus where you're just doing funky stuff in Excel and think about, okay, how can I tweak my conversion rates and assumptions and so on, but really go out, talk to customers, try to really understand their pain points, and try to validate your problem solution fit. Yeah, and because this is the only thing that is really traction. Forget all about this business plans, and I also wrote a really in-depth article on that, why you should forget about, or like why 98% of the entrepreneurs should forget about business plans. Yeah, not about planning, but about writing 60-90 pages business plan, but really trying to get traction. And the only traction is really going as close as possible to paying customers.
Yeah. Now I'll link to that article about the business plan that you that you're mentioning. I'll find it, because I do agree with you that a lot of time is spent just writing, but not enough on the other side. They think it's just business plan is going to do it for them. It's not going to do it for you.
Right.
I mean, that no business plan survives contact with the customer. So there you go.
Right. Because the thing is, for example, with my own business, and when I talk to other entrepreneurs, it's important that you have a plan, yeah, so that you know, okay, what is my vision, and what are the key steps that I want to get to that, yeah. This you should be having, yeah, and you also need to think about, how do I secure my competitive advantage so that I can, once I get to, for example, market leadership, that I can push other competitors out there. You need to think about that. But what you don't need is a business plan. And the cool thing is, investors don't give a fuck about it. They don't read it. And even if you have your pitch deck, they only spend like 2, 3, 4 minutes on that. Why should they be reading your business plan for 2 or 3 days? No way. Yeah? So why are you wasting your time for all this bullshitting exercise, wasting like 2, 3 months and tweaking that and so on, when you, and especially in the beginning, you need to be very agile, because when you talk to customers, maybe right now you have the hypothesis, okay, this might be the pain point. But once you talk to them, then you find out, oh, actually it's not. If your business plan was solely based on these assumptions that this was the pain point, all the rest, the derivatives, are crap, totally wrong. So it doesn't make sense to waste this time. Yeah, and investors really don't give a shit. They want to see that you have a product that customers love and happily are paying money for. Yeah, and this is the true validation. Everything else is just theory.
Well, I couldn't say any better than you did just right there. It's validation is having proof that people like your product and they're willing to pay for it continuously. And there you go.
Right. Jorge, thank you so much.
Martin, thank you so much for joining me. Are you on Twitter? Are you on any social media that you want me to mention?
Yeah, I'm on Road to Funding. I'm on Twitter. Yeah, I can share with you. I can share with you the Twitter ID.
Very good. Then I will share this with my on my blog, and you'll see the video. I'll share it with you, And thank you so much again for sharing your knowledge with me and with my followers.
Great. The only thing that my goal is that if the people really can benefit from it, then I'm happy. Yeah.
Yeah, and I'm happy to share it. I mean, really, thank you for sharing it with me. Thank you for reaching out, because when I saw it, I was like, my God, we had to talk about this.
Good stuff. And I mean, we can do some follow-up thing. I don't know, in 1 or 2 months or so, if you think, okay, there's some other topics, because I'm on average posting 1 article a week or so. So this is my planned schedule, because I don't have more time for that. But if there's anything where you think, oh, that's very, very interesting and helpful for my people, we can talk about this as well.
Sure, of course. And I'll start following you on Twitter. And if you have something that you write something again, send it over to me, and we'll take it from there.
Great, Jorge, enjoy your day, and thanks for having me.
Thank you so much. Okay, Thank you so much. Bye bye.